Well, here we are in mid-February, and the bond market has pushed out the rate cut timetable, but share markets don't seem to have gotten the memo. Hi everyone, welcome to the Traders Circle weekly market update. Today is Tuesday, the 13th of February, 2024, and before I get started, you do need to be aware that whatever I say is general advice only, so you have to consider whether it's appropriate for you. So, I guess the first thing to touch on this week is the earnings season. We're seeing the US earnings season start to wrap up, and we're about to enter the Australian company earnings season. In fact, we've already started. We've had 2 of the top 20 companies, I believe, report earnings, with CSL and Transurban both falling relatively strongly after somewhat disappointing earnings results. It should be worth noting that despite the crazy move higher we've seen in the Australian market over the past 3 months, earnings are actually expected to be a little bit softer this season, with earnings lower than last year forecast for the average stock on our market. Now, it is a bit surprising that we have rallied so heavily into the season, but obviously we've been driven by strength overseas, strength in the large US markets, and a hope and a belief in rate cuts coming many times this year. Looking outside the very, very largest of US technology stocks, really, their earnings season hasn't been particularly strong either, and perhaps I'll touch on that in a bit greater detail next week. But their market has been sort of boosted by the earnings season because the Magnificent Seven, although maybe now the Magnificent Six, has just kept rocketing higher. Really, really strong share price performance from companies like Facebook, who declared their maiden dividend this season, Nvidia, who's selling a bunch of graphics processing units to AI companies or companies that want to get into AI, and obviously the other large technology stocks doing very, very well as well. So their season looks good from an overall perspective, but realistically it's more a handful of stocks that are making it a good season as opposed to everyone doing well. We're going to see a ton of Australian companies report across the next few days. The most important of these is probably CBA's report tomorrow. Now, CBA's report is basically expected to show relatively flat, perhaps even a slight drop in earnings from 2023. And if that's the case, it does call into question whether or not the current share price, which is almost 10% into a fresh all-time high, does call into question that extreme share price level. Dividend is expected to be flat. Some people are saying slightly higher. Some people are saying slightly lower. So the dividend will be another thing to watch. The other 3 of the big 4 banks aren't reporting a full report this season. They will give quarterly updates, but they won't report a half or full year. And so this report from CBA will likely influence how the other banks trade as well, and will probably determine whether our market can hold these highs or come off from here. So following CBA, we've got quite a few other big names this week, including I think about 3 other top 20 stocks. But after CBA, the most important reports will come on Tuesday and Wednesday next week with BHP and Rio. Again, not particularly strong earnings results expected there, despite the current very high share prices. So I do think there's a bit of risk this earnings season. I don't think earnings have really caught up to justify the current market levels, so we'll have to just wait and see whether the market can shrug that off, or whether it will bring valuations back down a little bit to earth. The next thing to talk about is CPI. We're going to see US CPI growth for January reported tonight, and this is a very, very important one. This is probably going to determine the narrative around rate cuts, probably for the next month globally. Obviously, the market had pretty firmly stuck in its head that rates were going to be cut by the Federal Reserve in March. Then we had the really strong January CPI numbers, and that's basically pushed out everyone's rate cut expectations from March to May. But I think the reality is, overall, there's no signs of a weakening economy. There's no signs of inflation continuing to fall right down. If anything, inflation's fallen to a bit of a level and it's stabilized around there, and other economic data looks extremely strong. Better than expected GDP growth, better than expected unemployment. And realistically, I think there's a chance that these rate cut expectations get pushed out again. So we will see that CPI data reported tonight. If it's in line or above expectations, I do think we're going to see selling in equity markets. And if it's below expectations, maybe that'll allow markets to hold their current levels. But markets do look a little bit overpriced up here, particularly those stocks that aren't expected to improve their earnings. So the rate cut timetable is the big debate for everyone. The majority of Australian economists still believe rate cuts here are going to trail the US, probably coming around September, is I believe roughly the consensus. I suspect, however, that if the US does start to cut from May, and they've done a couple of cuts sort of by September, maybe even before that, we might even cut before September. So it will probably follow the US. Our RBA will probably follow what they do over there. Obviously, it's going to be data dependent, but again, the majority of US, well, the market in the US actually still believes that they're going to get the rate cut in May now, after originally believing they would get it in March. Whether or not that's the case, I'm not too sure. So about 55% of the market believe that we're going to see the rate cut in May now. Whether that's the case, I'm not too sure. I think if data remains at its current strength, we're certainly not going to see that happen. We will need to see data deteriorate a bit before I think the Federal Reserve can be confident in cutting rates. The worst case scenario for them would be for them to cut rates and then inflation start to bounce again. And I don't think that's out of the question. Keep in mind, we've seen oil rise 10% so far this year. We've seen a lot of other commodities hold up in price as well. Overall, we're not really seeing slowdowns in economic measurables. Unemployment's still extremely low. Growth is still very high. So I'm not really sure where this big willingness to price in rate cuts is coming from, because data really hasn't suggested that just yet. The one thing I will say, the one thing I will remark on is that keep in mind that a lot of forecasting models, as their key assumption, forecast things like inflation coming back to target over time. That's an assumption that they make. So when they sort of plug that into their models, their models have to show inflation, returning to target over time. So it doesn't necessarily mean that's what's going to happen in the real world, though. And I do think that that's caused a bit of overpricing of near-term rate cuts, particularly in the US. So let's have a quick look at the charts. And obviously we've seen a very, very strong upwards movement in US shares for the past 3 months. They're up over 20%, I think about 25% at the moment, since the lows of the end of October. Overnight, they actually got to a fresh all-time high right around 40.50, and then they pulled back. And they pulled back and closed slightly in the red. A candlestick analyst might call this a gravestone doji, and it's where the share price pushes up, tries to go higher, and it can't go any higher and comes back down. What we'll be looking for tonight is another bearish candle, in which case it would complete what we call an evening star pattern, and that would point for a bit of a pullback in the market. And if we do see a pullback, we might see the market in the US come back towards the trend line. Currently that sits around 49.50. Again, not too far away, 1.5% away. I don't think it's too unlikely, especially, like I said, if that CPI data is a little bit stronger than expected. So that's what I'd be looking for tonight from the US, potentially a formation of an evening star pattern. For our own market, we haven't been quite as bullish. We did have a bit of a pullback in mid-January, and we've had a little bit of a pullback throughout the start of February. Still set a higher peak, and we may be looking to set a higher trough, but overall, it does look like we're willing to hold below 7,700 as resistance. And should we fall off from here, my downside targets would be this potential support level at roughly the trend line, right around 75.40 at the moment. That would be the line that I'd look for to break for further selling to look likely. We'd have to close below 75.40, in which case there's several other levels, but we might eventually see a move back towards 73.50. If we do bounce off the trend line, the resistance at 7,700 would be the mark to beat. For our own market to break 7,700, I think we'd need to see better than expected results from CBA tomorrow, as well as perhaps from the miners next week. So I will wrap it up there for this week, guys. Markets are starting to look a bit toppy, particularly the US market, which has been sustained by about 6 companies. Whether or not we see falls from here could come down to the CPI tonight, could come down to local reporting, so we'll just have to keep an eye out on those events. So hopefully you guys enjoyed, and I'll see you in the next one. Bye for now.